Hi, this is Rick Patel here. I am the portfolio manager of the US Dollar Bond Fund. Thank you for your time and for your patience in listening to my views on the market. There's been a lot going on, so I'm happy to share my current thoughts on the portfolios as well as the market outlook. Starting with where we have come from, it's been quite a change in markets. We started the year positioned fairly defensively in the funds, largely on account of valuations in the corporate bond market, which to us seem to be fairly extreme in terms of levels compared to history across a range of sectors. The opportunities presented by the virus outbreak over the course of February and March allowed us to reduce our defensive position and move into a position where we were able to benefit from some of the attractive valuations in the corporate bond marketplace. To give an indication of what we have done, we started the year with a portfolio that was about 70% in government bonds and 30% in corporate bonds. Just after Easter, we're sitting with a portfolio that is 40% in government bonds and 60% in corporate bonds. So we have moved 30% of the portfolio in a short space of time to take advantage of the numerous valuation opportunities that we see across a range of sectors. It's a very complicated picture at the moment, as you can imagine. The size of the US fiscal package is $2.2 trillion. That is the largest single fiscal stimulus package the world has ever seen. It's approximately 11% of US GDP. This number would just have been unimaginable just a few months ago. And here we are with trying to digest the scale and significance of this fiscal package. What I do think is that this package has got numerous features to it. Obviously, the most focused ones are on the increase in the support for those businesses who are under pressure from the virus as a result of a lack of revenue growth, as well as support to the workers who are going to be losing their jobs as we speak and for the next few weeks as well. But there are other facets to this bill as well, which I do not think the market has paid enough attention to. For example, there are clauses that affect the operating losses that companies can carry forward and offset against future profitability. There's caveats around interest deductibility as well as interest deductibility of debts against future revenue growth. There's a huge range of features with this tax bill that we are doing some more work on to understand the winners and losers and the longer term implications of this package. Needless to say, the economic data will be fairly negative across the board, there's no doubt about that, but the market is now looking forward to seeing at what point can the economic data recover. Will the fiscal stimulus package be sizable and rapid enough to offset some of the economic deterioration that we're going to see, and what does it mean for markets? My view on the longer term outlook for the US economy is that I think we'll see a mindset change both from the household sector and the corporate sector to a higher savings mindset. So savings at an aggregate level at both the household sector and the corporate sector will pick up sharply. This will be offset by the extra spending that we are seeing at the fiscal level, at the government level. But I think on aggregate, typically government sector spending has a lower multiplier than private sector spending, and overall spending will be declining more so than we've seen in recent years. This is a headwind to growth. We expect growth rates to be low. We also think inflation will stay low. Inflation in the US, using the CPI measurement, is not a perfect measure of prices that individuals will experience, but it is the measure that the market follows and that the Fed follows most closely. We think that will be a low print for some time to come with little upside stimulus potential. Hence, we have reduced our inflation exposure in the US fund to zero. We think that whilst inflation valuations look attractive, we do think that they have room to fall further. The inflation markets are now pricing in the average for the next 10-year inflation in the US to be about 1%, which sounds like it's an easy bar to achieve, but we think that the market should be priced even lower still before we think about taking a position in the inflation-linked market from the long side. We remain constructive on the Treasury market. We think the Treasury bonds will be supported by the Fed's very aggressive actions to effectively increase the size of their balance sheet considerably to offset most of the fiscal package, if not all of the fiscal package that's been announced, as well as the corporate bond buying program that they have also announced. We stick to the principles of buying corporate bonds that we want to buy rather than those that we think the Fed will buy, as we think that's the best strategy to generating strong capital gains for the investors, as well as relative returns for bonds against the government bond index, which is so a 10-year government bond now has a yield of 0.6%. We think it makes sense to start to use some of this liquidity that we have in the US Treasury market to find opportunities in the corporate bond marketplace. The sectors that we are overweight, that we have built our overweight in the last few weeks, include TMT, industrials, the consumer sector, healthcare sector. We're fairly neutral in banks, having been underweight, so we've closed the underweight and gone back to neutral, and we remain underweight in emerging markets.
投资一定有风险，基金投资有赚有赔。申购前应详阅公开说明书或投资人须知。